Welcome, everyone. I'm David Silver, CEO, and I'm joined today by CIO Matt Harbert. Thanks for being here as we dive into 2025 market landscape and explore the projections shaping 2026 and beyond.
Thank you, Dave. I want to spend a few minutes looking back at what really mattered to markets in 2025, and then talk about what we think could matter most as we move into 2026. I'll focus on a few big themes, such as what drove markets, what surprised investors, and what we're watching next. So let's start with US equities and the Magnificent Seven. At the beginning of the year last year, it really looked like we might finally get the long-awaited broadening out of the market. Early on, the biggest tech names significantly underperformed the rest of the S&P 500. At the end of the first quarter, the Mag 7 companies underperformed the remaining 493 companies by over 16%. A couple of things drove that shift. First, the release of China's DeepSeek AI platform raised real questions about competition and long-term profit margins for US mega-cap tech. And second, tariff announcements came in much higher than the markets expected, which added to uncertainty around growth and margins. For a while, it looked like leadership was finally changing, but as we moved into the second quarter and beyond, that story reversed. As investors had time to digest the AI and tariff headlines, fears moderated, earnings remained strong, balance sheets stayed healthy, and while we're still waiting for the final year-end results, by the end of November, the Magnificent Seven had clearly reasserted their dominance, outperforming the remaining S&P 500 companies by almost 10%. So the Mag 7's market leadership is still very much intact, and concentration risk remains an important issue going forward. So another major theme in 2025 was the strong outperformance of international equities relative to the US. This wasn't just a short-term trade, it marked a meaningful shift after years of US dominance. Developed international markets and emerging markets both outperform US equities due to several forces working together. First, valuations outside the US started the year much lower. Second, growth expectations stabilized abroad, particularly in manufacturing and exports. And third, the US dollar weakened significantly during the year, which created a tailwind for international returns. The shift highlights the importance of global diversification and was an important lesson after many years where the US market seemed to be the only game in town. Turning to monetary policy, last year was a year of pauses and restarts. Early in the year, the Fed paused rate cuts amid concerns that inflation might reaccelerate. But as employment data significantly cooled over the year, the Fed shifted courses again. Rate cuts resumed in September, and total cuts for the year came to 75 basis points. That said, policymakers remain cautious. Large fiscal deficits and tariff-related inflation risks keep the Fed from moving too aggressively. So while rate cuts were a tailwind for markets, we did not see a return to that ultra-easy monetary policy. So now moving on to some important themes we're watching out for in 2026. Let's continue with monetary policy. The big question going forward isn't how fast rates will fall, but where they will ultimately settle. We expect continued easing, but at a slow and more deliberate pace. The Fed will remain very data dependent, balancing a cooling inflation, a gradually slowing labor market, and ongoing fiscal and trade uncertainties. For markets, this means rate cuts will continue to be supportive, but the Fed will most likely no longer be there to rescue markets at the first sign of trouble. Bond yields may stay range-bound, and equity markets could become more sensitive to inflation and wage surprises. On the US economy, our base case for 2026 is slower growth, but not a recession. Consumer spending should cool, but it remains supported by relatively healthy household balance sheets and continued income growth, even if that growth is slower. Business investment is a key swing factor. Areas like technology, infrastructure, energy and reshoring will be especially important. The main risks are further softening in the labor market, tighter credit conditions in interest-sensitive sectors, and policy uncertainties, especially around tariffs and fiscal debates. Bottom line, we expect the economy to slow and growth may feel bumpier than what investors have become used to in prior cycles. On the dollar, consensus view heading into 2026 is for more modest appreciation. Key drivers include narrowing interest rate differentials, improving growth outside of the US, and persistent US fiscal deficits. That said, dollar weakness is unlikely to be linear as rebounds are still likely during periods of market stress. A softer dollar is generally supportive of commodities in emerging markets and does reinforce the case for global diversification. That brings us to one of the central questions for this year. Does US leadership reassert itself, or does the global rotation continue? US equities still benefit from innovation and strong corporate profitability. At the same time, international markets look attractive due to lower valuations, more accommodative policy in many regions, and potential benefits from a weaker dollar. What really matters will be earnings growth outside the US megacaps, industrial and cyclical recoveries abroad, and policy risks tied to trade and geopolitics. So stepping back, we believe the big picture for 2026 will have a policy which is supportive but restrained, economic growth that is slower but manageable. The dollar will likely have a gentle downward bias, and equity leadership may become more broad and more global. A key takeaway is that 2026 increasingly favors diversification rather than heavy concentration in a single market or theme.
Matt, thank you for that. And if you're watching this video and have questions about your portfolio or about our outlook on 2026, feel free to hop on our website, instrumentalwealth.com, schedule some time with one of our advisors. We'd love to have a deeper conversation with you about this. Thanks, everyone, and here's to a great 2026.